We often look at companies going into earnings. We should probably look at a couple of them coming out of earnings as well. We're going to provide an update on the Tesla trade we talked about earlier this week for those who didn't see our post on X, aka Twitter. And we'll also talk a little bit about oil services company Halliburton, and we're going to take your questions today on Open Interest. Hello, everybody. Welcome to Open Mic. I am Mike Coe. This is brought to you by OptionPlay, as always. And an important note about that, we now have the ability for me to share links to the trades that we construct in the application in the chat. So if you don't happen to have OptionPlay, we're going to put an affiliate link in there too. You can just sign up for a free trial and you'll be able to see them and interact with them in real time. So I'm going to actually try to go ahead and do that and make sure that that is in the chat so that you guys can see it. Okay, so big week. We've got even bigger weeks coming up with respect to earnings. Obviously, we got some news out of Tesla. Let's talk a little bit about Halliburton first. That wasn't a name that actually I'd brought up ahead of earnings, but I think it's okay to talk about it out of earnings because I think we got some visibility here on what's going on with the company, and we might actually have a way to trade this thing. So first things first, company beat by 2 cents a share, and this came as a surprise to the street. The consensus was that the company was probably going to see flat or declining revenues from North America. Now, Halliburton has more relative exposure to North America and North American fracking than their larger competitor, Schlumberger. And so this came as a positive surprise. In fact, it was enough of a revenue beat from the North American operations, about 5%, that actually they saw a very modest revenue growth. That was not what the street was really expecting there. Company's not particularly expensive, and the company did perform fairly well coming out. So I thought we might just start by taking a look at that and seeing whether there might be something to do. This is a company I've followed for a long time, for those who don't know. I'll give you just a little bit of a history about where I started in the business and one of the reasons why I've looked at some of these energy names for as long as I have. I started off as an options trader as a member of the Philadelphia Stock Exchange, and we traded a number of the oil service companies at that time, single stock options, but I was also making markets in the oil service index. So kind of before, sector ETFs were really a thing, really before ETFs were really a big thing, we had sector indices. Philadelphia Stock Exchange was where a lot of those were listed. They had the bank index, oil service index, a couple others. And so this was an area that I trafficked in. And when I moved to the American Stock Exchange a couple years later, traded, let's see, what are we looking at here? Okay, so we're looking at okay, you're seeing this one, I guess. Just making sure I have the correct. All right, so I have the app up in a couple places, so when we bring this up, if we're working through the screen share, forgive me, we'll get that sorted out, I'm sure. Was trading Halliburton as a specialist there, and then later I went to the New York Mercantile Exchange and traded some oil, gas, and the options complex on those. So the interesting thing here about Halliburton, and why don't we, I don't know which screen the producer is actually seeing of mine, probably something we might have wanted to. Okay, so this is going to look a little different. Let me move this application out of the way. I'm going to switch some stuff around because it seems that the screen share is grabbing something different than it usually does. But hopefully this will look okay. All right. That's my apologies. This is okay. So why don't we just go into the app, into the Halliburton options play right here. So we can see that the stock obviously has performed pretty well recently, but if we go further out in time, and I think this is important, we're going to see that actually this stock has done very, very little over the course of the last couple of years. this actually, to my eye, presents us with an opportunity for overwriting. I don't expect enormous growth out of this one, but I think they are indicating that they're in a relatively solid place. And so we often want to see situations where you get a stock that you're comfortable selling some premium, not expecting a couple big blow-ups. We've now gotten a situation where we've gotten a little bit more visibility from them. And interestingly, so North America did better on this most recent earnings report, but the guidance that the company was providing for the full year and looking ahead to 2025 is that international may start picking up some of the slack. Oh, one quick point also, programming note, for those of you who are watching this, you may notice that the color palette for the application that we're sharing right now is different. We have a dark scheme, we have a light scheme. I know some people are looking at this on phones, other people are looking at it on their computers and their laptops. Please give some feedback, tell us which one is easier. My understanding from at least one viewer was that it was easier to see the lighter color if you are looking at this on a mobile phone, and since that's a smaller screen, I'm kind of leaning in that direction. I'm partial to dark screens myself. Okay, so the trade idea for me here, if you don't happen to have a position in it, would be actually to write tight cash covered puts as a way to potentially enter the stock, collect a little bit of income. Not a lot of great places for income collection these days. So if you don't happen to own the stock, this is what you would do. You would look to sell something close to an at the money or just out of the money put. And I'm just going to hit this trade button and drop this in. So we're going to experiment with this a little bit and see whether you guys can actually click on these links that I'm posting. So selling the June 38 puts, we can see that you're going to collect about $1.21 for that trade. This thing is going to expire in basically a couple of months, $1.21 over. I'm going to use the strike price because that's really the way to think about the risk, is where are you going to actually be forced to buy the stock if you are compelled to. So if the stock falls through the strike of a put that you've written, there's a risk that you will be assigned. That is, say, you would purchase the stock at that strike price. So that's kind of the way I like to think about risk on put rights. That's going to work out to about a 3.2%, just under 3.2% yield over the course of 2 months. But this is a stock that if you don't own it already, I think I would be comfortable writing. Notice that if you're selling the Junes, you're not actually writing into the next catalyst because they just reported yesterday. Like I said, 2-cent beat there. Now, if you do happen to own the shares, then you would be doing a covered call. And here, I probably want to give myself a little bit of room. The objective here is to sort of think about what potential levels of resistance might be, look to sell a strike like that. We see it's defaulting to the 44 strike, which would actually give you a substantial amount of upside if you were to sell it there. But most people who are viewing probably know that when it comes to collecting options premium, I kind of want to lean towards getting at least 1% a month at a minimum if I can. The logic of that is that you are taking equity-like risk. I want equity-like returns. So I would probably choose a slightly lower strike. Notice, at least by this technical metric here, that we see resistance around 40.5. So if you're going to sell a strike that's a little bit lower, you should probably feel safe doing that. Let's see here. So if we go to the June 41s, you're going to collect 80 cents per share. So once again, that's going to work out to, now you could look at this as the strike or the current stock price in terms of yield. So I'm probably not, where I used the 38 strike of the put when I was trying to calculate my yield there, because that was basically how much am I getting relative to the risk of where I'm going to own the stock. Here I already own the stock, 38.72, looking at about 80 cents. So that results in also about a 2% yield. And you have some upside capital appreciation here, right? So worst case, the stock runs through that 41 strike by more than the 80 cents that you're collecting to do this trade. Actually, how much is that? Let's see. Yeah, so you have a decent amount of upside on that trade. So kind of an interesting one. Schlumberger, which actually had been outperforming, and I think we have a chart. See if the producer can pull that up. I have a chart of Halliburton and a chart of Schlumberger. For quite a while, Schlumberger had been outperforming pretty materially. I'm a little less enthusiastic about Schlumberger here than I was. They also have reported, but that thing just broke below the 150 to the downside. And so, all else equal, I think I'd rather be in Halliburton here. One other oil name, and I don't know if we have a chart of this one, that I think is kind of interesting. This is, normally we're going to talk about the mega cap stocks, but I thought this was just a little bit interesting as well. I was looking at Kirby. So this is a stock that has recently done exceptionally well. Let's see if we can take this out a little bit more in time. I think it's a little bit extended here, but the stock is still cheap. Houston-based oil barge business, probably trading less than 17 times forward. Like I said, it's a little extended to my eye right now. It's just had a heck of a tear lately. But this is another one that if it pulls back, back below, call it, to that 95 level or so, this is one that I think I would start writing puts against this one pretty aggressively as well. Okay, so let's skip ahead from old technology in the oil business to the new technology and the elephant in the room, and that is Tesla. So those of you who are watching on Monday know that, well, you know a couple of things if you've heard me talk about Tesla over the course of time. I think the company is facing a lot of pressure from BYD. That's one of the things we talked about. I think they're facing pressure because they are not really aggressively getting into the light truck market. The Cybertruck just had that recall. Company was implying about a 10% move going into the print. We got that and then some. And actually, I think I have, let's see, I believe I have the trade. So the trade that I had articulated on Monday was a strangle swap. So what is a strangle swap? Sounds complicated for those of you who aren't familiar. It isn't really. Basically, it's two calendar spreads. So I basically was taking a look at 10% move to the upside, 10% move to the downside, trading a long calendar that captured the subsequent earnings for both the call and the put strikes. Logic on a trade like this is that you're trying to collect the decay for the options you're selling. I was guiding the strike selection by the implied move. It actually moved more than the implied. The objective in a trade like this, and actually we'll just construct a new one for the sake of illustration. But then what we're going to do is we're going to actually take a look at the one that I did recommend. So if you don't happen to follow me on Twitter, or X, whatever you want to call it, I do recommend that you do that because I will, I don't always, but I try to post updates when I have trades where there are catalysts and there might be something to do. In this case, the stock ran to the upside. That downside put, you could cover that essentially for next to nothing, and the stock had run very close to the strike on the upside that we had sold. So follow me on Twitter, get your updates there. Okay, so let's just take a quick peek at what I'm referring to as a strangle swap actually would look like. So doesn't really matter in this particular instance what I'm going to choose because this is not into the catalyst, so this is just for the purposes of example. So I'm just going to buy an out-of-the-money call. I'm going to buy, in this case, I'm looking at something that's about $15 out of the money to the upside, so I might as well do similar amount to the downside. So why don't we just look to the, we'll use the 150s on the put side. Buying the longer dated options, then going ahead and selling some near dated ones against it. I'm just going to go out to May. Again, this is for illustration. This is not a trade recommendation. We're going to get to the actual trade that we did and how that turned out in just a second. But I just sort of want to, anybody who was not a part of that, who is interested in learning a bit about what the trade structure looks like and is interested in something like that. So there, I'm going to drop that into the chat. Now you have access to it. Okay, so with that, I believe I can now, let's see if I can do this. This will be the first time I've ever experimented with this exercise, so I'm trying to take it out of this application and take a look at how this trade that we actually did talk about before earnings turned out and how to think about it now. So if you saw that one that I just put up, you will notice that the idea was it would profit if it ran to the high strike, it would profit if it ran to the low strike. Smaller profits most likely in the middle as a result of the vol crush. Vol crush is that the longer dated options are going to see some implied volatility. Options premiums are going to decay after the event takes place. Makes good sense. Options traders are insuring against a move. When the move takes place, it's going to be a little bit different. So this was the actual trade that we talked about at the time. Now, you will notice this thing is actually it's on current prices. So I should actually see what the price of that one was at the time. So give me a moment while I do that. Let's see. Okay. All right. So what's going on now is you will notice that this is actually run up to and then subsequently ran through the call strike. Now this trade was actually slightly profitable today. I think the prices that I put it on were about 19 bucks or so. I'm just going from memory now. About 22 now, so we'll call it up about 10% on the overall package. But one of the things you'll observe is that you have this situation down here where it's going to lose if it goes further to the upside. And it's going to, this has gone from being a relatively neutral trade where you could make money if it drifted to the high strike or make money if it drifted to the low strike. Now it's vaguely profitable. It ran a little bit past our target. But now you're in a very different position. So now, if you do not make an adjustment to a trade like this, as this P&L graph demonstrates, you're not really going to make money on a standstill basis from here. You're up a little bit, so you can just take it off and take your profits. Or you need to make an adjustment because this is pivoted from being a range-bound play to a bearish bet. This will make money if the stock declines slightly, but it will lose if the rally that we saw in the stock today continues materially. So we really have to think about two things here. One, do we think the rally could continue? What do we think about Elon's comments? Why is the stock higher? What are the dynamics at work here? And what would you do next if you were going to modify this position rather than just close it and take the modest profit that we made? Okay, so let's talk first about why the stock rallied the way it did. There was a lot of bad news and a lot of negative sentiment on Tesla, and I actually articulated some of this myself going into the print. Those things were the BYD pressures from China, the fact that they're losing the EV war to BYD in China, and BYD is now making more appealing products that could be sold internationally, and they can do it very cheaply. They have proprietary battery technology with these blade batteries that they have, and that's the most expensive component for an electric vehicle. The hockey stick of EV adoption and growth in North America has probably come to an end. This makes some sense, and I speak as somebody who is a fan of Tesla products and Elon Musk and their technology and their cars. We have bought 2 of these, and we have one right now. We have a 2024 Model Y long range. I think it's a great car. I think it's a great value. But these cars are not for everybody. Part of the problem is that if you do not happen to live in California, as I do, maybe the climate's not that accommodating. If you do not happen to live in a single-family residence, as we do, you may not have a charger at home. That could be an inconvenience. I think a lot of the people who were inclined to buy one of these because maybe it suited them, it suited their lifestyle, or they had a family where you have 2 or 3 drivers and therefore a few cars. Again, that's kind of our situation. An electric vehicle is very well suited. We have very high gas prices here. Most of the driving we do is local, and if we go on longer trips, we have other cars we can take. So I think it's going to keep a lid on it. The other thing that's really problematic is that we have, amongst everything else for Tesla, not just the pressure, which is going to pressure their margins, even if they could sell the cars at full price and at the same rate of growth as they had. So they've got margin pressure because they're in a price war. I think the EV adoption has slowed, and their sales, because they posted actually a sequential decline in that area, is problematic. But it's also a problem in terms of affordability because we have higher rates. And higher rates on expensive, durable goods or things like cars is a problem for consumers, and consumers are already stretched. And you combine that with everything else that's going on, and I think the problems that are facing them are going to persist for some time. So why did the stock rally so much? Well, the other news that we had going into it was that they were having a layoff, significant layoff. That seemed like bad news. The flip side of the bad news is that on the earnings call, they outlined that that's going to be approximately $1 billion a year in cost savings, which they obviously need. So that's an important element. Other bad news that had gone into the print was that they were not going to have the low-priced car. Elon dismissed those concerns and, in fact, rebutted them, and there was a big topic on the earnings call that indeed they are going to have these less expensive cars, and he really was advancing his robo-taxi dialogue. Add to that the fact that their build out in terms of their server farms, they indicated that they've largely accomplished what they wanted to there. They talked about licensing full self-driving to other manufacturers. They've already entered into an agreement with Ford so that Fords can use the supercharging network, which I think is very important for every other EV. I'm definitely seeing that EVs, at least where we are, where there's big EV adoption, if you don't have a Tesla, that's a problem because there is very few chargers on a relative basis. There's tons of Tesla chargers. There are few of any other type. There are waits. There is impatience. It's a problem. So this is a real strength for Tesla. So if you happen to own the stock, I'm not going to tell you to sell it here. I had figured that, to my eye, a reasonable place to buy the stock, if we thought that they could accomplish that 367 or so that the street was expecting from them. That was the full year EPS estimates that the street was expecting ahead of time. And let's just see how that number has changed since earnings. If it has come down a little bit. So now the street's looking for about 351. That would represent 33% year-on-year adjusted EPS growth if we just use that as a benchmark for a multiple. That gets us to, $1.20-ish a share, maybe even a little bit lower. I think it's okay to pay slightly. Look, it's Tesla, it's Elon. I think a premium to that number is fine, but that's still well below the current stock price. So if you're fortunate enough to own the stock into this print, absent any other immediate catalysts for the stock, and just knowing that this is one of the few names that actually has some reasonable volatility to sell, I think you could sell some covered calls into this one as well. Which means that if you are in this straddle swap situation, because there are parallels, you're trying to sell near dated premium and kind of own things longer term, what you would do if you own the stock, write upside calls against it. If you're in this strategy, what you need to do is adjust these strikes. And I would, you don't need to go quite as wide, but you might as well if you're going to go out in time. So now we're going to use, instead of, we're going to use 162 as our frame of reference. So I had that trade up there. Where did I put that one? Oh, here it is. Sorry. Let's go back to the original one I had. So I'm going to blow this up again. All right. So we are looking now at, say, May, August as our structure. So you want to adjust and go into something like this. Notice you're going to spend a lot less money to put this one on, like a May, August. Why is that? Because you are not dealing with earnings necessarily. Their next reported earnings are going to come in July. Yeah, so this is one of those tricky situations. Bloomberg's got it for July 19th. No. July 19th is a Friday. It's probably not going to be Friday after the close. That's not when companies report. Berkshire reports on Saturdays, but everybody else typically likes to report earlier in the week than after the close on a Friday. That's when they drop bad news. So August is going to capture that. May clearly will not. Write repeatedly against this. I just want to make this point, and it's an important one. If you put this trade on, please do not simply wear August through the next earnings print. So it's going to be a couple of weeks prior to mid-late July that they're going to actually announce when their next earnings are going to be. So right now everybody has estimated earnings, whatever your source, whether it's your broker, whether it's Bloomberg, whether it's TradingView or whomever, whether it's OptionPlay, which has an earnings date in here. And actually, I'm kind of curious about that. I wonder what, doesn't really matter that much because, like I said, the earnings date, this has still got the stale earnings date, so that's not actually relevant. But when you come in here, just know that if you really want to confirm, this is actually an important point no matter what. Don't just rely on whatever third-party system you have. Companies will announce formally when their earnings are going to be released. So what you have to do is go to their investor relations website. You'll be able to do that a couple of weeks ahead of time and just see, they'll say exactly when it is. But you don't want to just wear this August strangle into that print because then you're going to get nailed with that vol suck. Okay. With that, let's go ahead and try to take some questions and see what we have. Okay, this first one from J. Phil. How would you handle or handled long 5/16 puts on SPY? I was down 30% at one point, sold 20% for a 50% gain. The remainder got to 100% and are now back at 30%. Okay, so I'm going to assume, and by the way, if I'm assuming incorrectly and you're sort of following this along, add more comments to give me a little bit more. So I don't know what expiration it is you're referring to here, but I'm going to assume that the 5/16 puts that you're talking about were a portfolio hedge. So oftentimes I will actually, it's interesting. And actually I may not have done a great job of talking about this. When I talk about hedges, I don't think I've actually talked about the exit strategy. What I will typically do oftentimes is I don't necessarily take the puts off. I will delta hedge them though. So if I get a big decline, I might actually, rather than peel off those puts, I might actually buy some SPY against it if I think that the near-term drawdown is a little bit overdone. So I'm going to actually try to estimate which ones you June expiration. Okay, I've just heard. Somebody just told me that. So June. Okay, so why don't we assume June regular 5/16 expiration, or if that's month ending. By the way, if you're wondering, I often use month ending. Why do I use month ending? It's no really good theoretical reason for it, but the thing is that the Fed, some of the PCE data comes out at the end of the month, and that's sort of the Fed's preferred measure of inflation, and I always feel like, do I not want to pay up for the extra week to 10 days or whatever so that I can capture the PCE data? It's kind of foolish because actually the truth is that options are always going to be priced appropriately for these catalysts. It's not like the market making community are completely out to lunch and don't know what's going on. But let's just take a look at this. Okay. Regular expiration. So here we go. Let's take a look at how these traded. So one interesting thing about these is, so this is a history now that we're looking at, and you don't need to concern yourself too much. This is the open interest is down here at the bottom. So I'm just going to get rid of that so we can just take a look at the historical price. This is a historical price chart for that put through time. It's not the price that actually would have dictated whether or not I would have adjusted or rolled these. But the delta or the moneyness of that option most certainly is. So if I'm buying, for example, a 30 delta put as a hedge, once that gets well in the money, and I think that's probably what you have here. So SPY right now is at 505, so these are 11 bucks in the money. What you're losing is you're losing sort of the convexity, the benefit of optionality, that convexity. You basically just taken on straight short delta. It's almost as if you sold SPY against your portfolio, which is definitely a way to hedge. You're hedging your beta. But you lose the benefit of the curvature that an option provides you. And that's, kind of one of the things that really appeals to most. So what I would suggest, and why don't we just take a look at these options specifically, and this is going to look like a spread on your screens, but actually what I'm doing is I'm actually talking about what the trade would be to consider rolling. And I might try rolling down to a, call it a 30 delta option. So you can see in here, by the way, when I select the strike, see this number over here on the right. This is a 57 delta option. Now, people who, I've been asked a question on the delta front, and I've often said that, generally speaking, I roll options when they get to a 60 delta. So if I bought a 30 delta option and it gets to 60, it's a good chance I'm going to be rolling it. And the thing is, you actually would have gotten to 60 when this put was a little bit higher. So probably I'm guessing it would have tripped that 60 delta back on, probably the 18th or so. And where was SPY at that time? So that would have been, 502 level. So what you would have done is you would have, when it was a 60 delta at that point, and look, everybody's going to do this a little bit differently. You can select what delta works for you. But I don't own options that are deep in the money, generally speaking. I would rather have them out of the money, and if I need to have exposure to the underlying somewhere in the middle there, I use the underlying to do it. It's much easier to trade your deltas with the underlying stock anyhow. Once the options get deep, and this is not so true for SPY because the bid-ask spread is very tight, but it's worth noting that if you buy a long option and it runs, you'll often see this. When that thing gets deep, the bid-ask spread gets to be very wide, and you can trade and you can probably get a fair price, but it's annoying. You have to sit there and walk your limit down until you get a fair price. You're kind of trying to monitor what the intrinsic value is so you don't get somebody taking your face off because the spread is $1.50, $2 wide. And, those are the kinds of things you want to keep an eye on. So roll this thing, and what you would see here is that you actually would have taken $9 in. what's the difference between having done that and just sold some? Well, the difference is you still would have taken some money in because you just sold the options that you had. The difference is that if the weakness we saw in the S&P had continued, you would have still owned a like amount of contracts and you would have had the benefit of convexity again. So that's, I think, a way that I would think about monetizing instead of just peeling the position off as it gets further and further into the money. Roll down if it's puts, or if you're doing the same thing on, if you're trading something else onto the upside, roll up, take money off the table that way. And that's actually maybe more important for a hedge than almost anything, because if you see continued weakness, you want your insurance to still be there. And that's a way that you can preserve that. Okay. So hope that helps. Let's see what we have here. Okay, that was that. And look at this. The very next comment I saw was, why do you like to roll when it reaches 60 delta? And would you do so even if the expiry is far away? This from Ranjana Gupta. If I'd really been scanning through all of the comments, how interesting. So that's the reason. The reason is so that I can take money, book some money, while maintaining a decent amount of notional exposure. That's the reason I like to roll in it just that way. Another quick important point, which is that as time passes, if you have longer dated options, the very reason that you chose them in the first place was very likely so that you could capture an event or multiple events. Also so that you are mitigating the amount of theta, because options decay more rapidly, at least as a function of their own price as expiration approaches. And because of that, long-dated options eventually become short-dated options and eventually expire. So rolling and adjusting your positions is something you need to do pretty consistently. For my hedges, we probably, we adjust those things every couple of weeks, I would say, generally speaking. Okay, so that's the 60 delta. Can we get an electronic copy of the book? The font is very small. I assume you're probably, I'm not sure which book you're talking about. It might be the Options Edge. I guess that's this one. I don't know if there's an electronic copy. There probably is. I should check that. Go on to Amazon and see. The other book that I have a copy of around here is by my good friend and colleague, Mark Guthner, which is published by McGraw-Hill. That was the Quantitative Analytics and Debt Valuation and Management. Good book. Little mathy. I guess they both are a little bit mathy. But this is about derivatives. Derivatives are a little mathy. I'm sorry about that. And you don't need to understand every bit of the math to understand how to trade options. It's just, sometimes it's interesting to be able to model things a little bit more. Okay, light is easier to see on my laptop. Good to know. I guess we'll probably run with that for now. I realize the font's a little bit small, but I hope that is helping. Okay. Oh, and the very next one, dark is better. So we can't satisfy everybody all of the time. We will see what we can do. All right, here we are. Here's one in the alphabet. Google sold the April 26, 167.5 calls, have the May 157.5, 152.5 put spread, costs for $2. Looking for pop? Question mark. Okay. You sold an upside. Well, let's put this trade in first of all, and think about this a little bit. I'm assuming the question to me is whether you're looking for a pop. And actually, if PC, if you could just contribute one quick thing, I'm assuming you say the cost of the put spread was $2. It's a $5 put spread. May I assume you bought the put spread? So if you're short a call and long a put spread, that's not a bullish position. But let's build this out. And actually, by the way, you can do this with multiple expirations. So this is actually a worthwhile exercise while we're waiting for that answer. We can sort of work this out. Okay, so May 17, the 157.5, 152.5 put spread. There we are. These are puts. We're buying the 157.5s. And that is indeed about $2. Okay. Now, we also want to add to this that shorter dated call. So here you just go in here. You can do this. We're going to sell the, was it the 167.5 calls? Okay. So this is what that structure ends up looking like. Standstill rate of return, as we can see. Makes a little bit more money to the downside. That downside is going to be capped because it is a put spread. The most a put spread can be worth is the difference between the strikes, $5 in this case. The total net debit at current prices for this is less than 50 cents because the sale of that call is offsetting most of the cost of that longer dated put spread. You know, actually, I'm curious and would like to know, and hopefully PC is watching this and can comment, is this against a long stock position? Because a put spread collar like this is a fairly common approach. And the company is going to be reporting earnings tomorrow post-close. Now, this is also a name I happen to like. It's also a name that has disappointed the last couple of earnings. I think it dropped 7.5% last quarter and 9.5% the quarter before that. So if this is a trade against that, against a long stock position, yeah, I do actually like it. I think that's a good way to hedge Alphabet going into earnings. So yes, against a long. Okay, perfect. Yes. No, that's a good trade. And basically, I like everything you've done here. So there's a lot to like in this structure going in. Let's think about this. All right. So what do I like about it? The stock has moved on average the day after they've reported over the last 10 years or so, less than 5%. That's the average. Doesn't mean they haven't had much bigger than 5% moves to the upside or downside. They have, but the average is less than 5%. The strike of the call that you sold relative to the current stock price, 167.5 versus round numbers. We're just going to say 159. That's 5.3% out of the money, give or take, round numbers. And it expires Friday. So the option you are short expires soon. We like that. You're using a put spread because you're capturing the event, and so options premiums are, again, they're going to be slightly elevated because of it. And the downside strike is at 152.5 is 4.1% out of the money. I might have given myself a little bit more downside room, but I can see why you didn't, because you basically are getting this thing on for pretty much even. Against long stock, let's put this in here because I want everybody to see what that actually ends up looking like. This is what your position ends up looking like if you have a trade like this on. You end up getting, you sell off a little bit of the upside, but it's not actually calculating this exactly right, because what you have here is you have downside protection. You know what I'm going to do so that this is a little bit easier to, I'm just going to bring this to April, all of this. And what you end up with is, so you can sort of see because we have options that are expiring on two different dates. What's going to happen is that if you're trying to model it, it's just going to go to the near expiration. So you're getting curvature associated with that. But what I'm really trying to demonstrate is that what you get is you're selling off some upside, but you're selling it near dated, doesn't typically move a whole lot more than 5% to the upside. So you're getting most of that upside. But happily, you're also getting some downside protection to the tune of about $5 against $159 stock. So you are going to offset any decline by about 3%. That's how much that downside put spread can be worth. So if it drops 5%, you're going to lose 2. It goes down 7%, you're going to lose 4%. That's, you're getting kind of an asymmetric risk-reward relationship right around the spot price, the area where it's most likely to trade. The put spread expires longer dated, so if you get a positive move following earnings, and they're going to report after the close, so there's only one trading day in those calls after they report. They're going to go away, and you get to reset and play again. So yeah, like that trade. I like Alphabet. Obviously, the last couple earnings hasn't traded well out of those, so I could completely understand using this as a mechanism to ensure that. So yeah, great. All right, J. Phil confirms that was a portfolio hedge. So again, rather than just peeling off your hedge, just consider rolling it. Take some of your profits that way. FinWest. Tesla is very popular in Honolulu. It's a great market since the climate is mild, easy terrain, simple range. Being on an island, where are you going to go? Yeah, it's a great point. Look, I think anywhere where the climate is, is kind of like what you're experiencing in Hawaii, obviously where I live in California, doesn't freeze, doesn't get overwhelmingly hot. So any things that affect the battery with respect to climate don't really affect us in places like this. The truth is, on an island, you're not going to go very far. Most people don't go that far. Even if you have a long commute, how far are you actually going to go? I mean, the thing has a 300-mile range. If you have a long-range Model Y, for example, and Model 3, I think they are very well suited to most people's needs. The challenge is when you start getting into more extreme climates, you have to go to cold weather. We go up to Lake Tahoe from time to time, 210 miles away, all uphill, of course. You actually have to go over Donner Pass, so you're getting up 9,000 feet above sea level. Temperature commonly will drop 30, 40 degrees as you make that drive. You can't really make that, even though you have that 300-mile range, in reality, it doesn't work that way. We have taken Teslas up there. We've taken 2 Teslas up there. A friend of my wife has a Model X, taken up there. Always have to stop to recharge it, whereas the gas-powered cars, we just get in and go. So I think that's something. But I also think that ultimately we're all going to probably end up driving these things. But all right. As for BYD, build your dreams. I see them fairly often here in Bangkok. Bangkok? We have a viewer in Bangkok? Wow. We've gone global. Thanks for watching. So Bangkok does get hot. The temperature there. I don't know how that affects those batteries. You're not gonna get too much freezing weather. But BYD is outbuilding Tesla, and if you want to know what kind of a competitor BYD is going to be, don't listen to me. Don't even listen to BYD, because of course they're going to say whatever they want to, but you have to take a little bit of what they say with a grain of salt. Listen to Elon Musk himself. I mean, he has said that they are a legitimate threat. He views them as such, even though he did not originally. It's one of the biggest automakers. They're going to get bigger. That's the reality. All right. As to rolling your hedges at 69 delta, that might be a typo because you said 69. I usually start thinking about adjusting my positions at 60 deltas, whether it's a long call or put. That's usually about the time I think it makes some sense. Does that apply to spreads also? Yes and no. How do I mean yes and no? I'm not looking at the delta of the spread, I'm looking at the delta of the option. So if I have a spread, oftentimes what I could do is I can just adjust the 60 delta. So I will maybe roll that strike out a little further and maybe leave the other one. This is particularly true, actually, if you are doing something into a catalyst and you get the bulk of that move, so it runs through your long strike, but not to your short strike. And so you can take some off and say, you know what, I'm going to try to squeeze the last bit out, leave the short strike on, and roll the long one. Now, that depends. I mean, if it blows through both, then chances are you're going to take off the whole thing or roll the whole thing. But it doesn't apply to spreads exactly the same because I might roll one leg and not both. So hopefully that makes some sense. Okay, Alex S. is asking, why did PC buy a put spread when he's looking for a pop? It's because he owns the stock. Average move in Alphabet, 5%, coming up with earnings, had a couple disappointing quarters. And actually, you know, I'm looking at this now. Out of the last 8 reported quarters, they have only popped on 2. It's not a great win rate. That's, look, you know, I'm not saying that that's enough of a pattern to say, oh, just because it didn't trade well. But what I'm saying is it makes sense to insure at low cost if earnings can be and have historically been very much hit or miss. Give yourself 5% upside, mitigate some of that downside. Very low cost trade. I mean, I think, what did we figure out? That the total cost of that trade was 40 some odd cents, 43 cents or something like that against 160 stock. You know, the cost of that trade, 27 basis points, 0.27% of the current stock price. And by the way, it isn't really going to be that, because if it stays within that boundary, that wing option on the put, the call is going to go away, and the wing option on the put is going to also go away. So you probably still have some value at that at the money 157.5 put. I actually think it's going to be, I think it's a good trade. I like it. Okay, so where are we? Here's a good, okay. So here's an interesting question. Ranjana Gupta asks, does it matter if we trade GOOG or Google? So GOOG or GOOGL, Golf, Oscar, Oscar, Golf, or Golf, Oscar, Oscar, Golf, Lima. In practical terms, no. The difference between these two shares is that the A-class ordinary shares have voting rights and the other ones do not. So like a lot of technology companies, they issue different share classes. Oftentimes they have shares that have voting rights, non-voting rights, or super voting rights. And the reason often is that founders like to keep control of the company. Depending on how you feel about the founder, that can be a good thing or a bad thing. Mark Zuckerberg, you know, controls the voting rights for Meta, formerly Facebook. And I think a lot of investors were very concerned about that, because when he started to really focus on the metaverse and started plowing huge investments into that and basically chewing up all of the company's net income, investors didn't like that very much. You know, in many cases, though, investors do like that, because we want management to focus on the long-term picture, and the founders, to the extent that they remain engaged and involved in the company, these people are very often visionaries, and they have a long-term goal in mind. I think that's true for Elon Musk with Tesla. There is no person I can think of or name that I would rather have running that company. Not to say the guy's not going to make mistakes. I would make a lot more mistakes if I was in that role. I am not the same visionary that he is. That's what you want, and somebody whose interests are very closely tied to the company. So the non-voting shares, though, do have a benefit for certain share class owners, and I've actually lived through that. So, you know, when I was running a 40 Act fund, actively managed, essentially a mutual fund, it was ETF. You know, we have to, you know, we basically have, for compliance reasons, we have to put our votes in. And so if there are proxies and things like that, you have to subscribe to services. It's actually a nuisance to vote the shares. And my vote's not going to really make that much of a difference in many cases. So sometimes you really don't care. And the two track together. In fact, actually, I can probably track the two right next to each other, and we can see just how closely they do track. Sometimes there's a minor difference in these prices, but for practical purposes, it's really not going to end up making that much of a difference to you as a shareholder which one of these two you trade. So let's go back 5 years. All right. You can see that this spread, there's a spread down here at the bottom, makes a little bit, one trades over, one trades under, but look at that. I mean, these things are trading essentially lockstep with one another. As we can see here, over the last 5 years, total return for the non-voting shares actually very marginally higher. But over any given period, that won't necessarily be true. Doesn't make that much of a difference. Maybe, hey, maybe you want to be a voter, want your vote to be heard. So buy the voting shares and wait until you get your ballot, put it in. Then you get to see, you still get to see what's on the slate when those things happen anyway. Usually, and what happens? I mean, most shareholders, they just vote the director's slate anyway, right? So whatever's there. This is what management recommends. I mean, how many times have you actually gone and said, okay, I'm going against what management's asking for? Okay. Here we go. Do you prefer to sell spreads on SPY, QQQ, SPX, and why? SPX? Couple of reasons for that, but I mean, part of it is a little bit of a habit. I mean, first of all, institutional users trade SPX much more often. SPX is a bigger product. I think the notional open interest outstanding is probably 6-7 times what SPY is. You'll see a lot more contracts trade on SPY, but SPX is a 10 times bigger contract. So actually, I mean, we'll just take a look. I mean, see what happened today. But that's actually not the reason. It's not just because of the open interest, because open interest is not a reason for anybody to stay away from SPY, because SPY is huge. Open interest is 20 million contracts for SPX. Think about that, by the way. 20 million contracts, 100 multiplier on a $5,000 underlying. Think about how big that market is. It's huge. The SPY market is also huge. Why do I prefer SPX? SPX is cash settled. And when you're trading a lot of names, and not trading that many names now, I don't know how many names we have on, but it's probably between 30 and 40. You don't really want things that settle into the underlying. If it's just more to deal with. SPX, because it settles to cash, it's European, it settles to cash, it's like trading a swap. So I just know that whatever I'm trading, I'm just going to end up with the money, or lose the money, I guess as the case may be. And that just makes it a lot more convenient. And there's still, if you have a CPM account, or if you're trading on a JBO, you still have the cross margining capability in the complex, right? It doesn't create a margin headache for me to trade SPY long, as hard deltas to trade SPY against SPX. Makes no difference. So I get the cross margining benefit. It settles to cash. The only thing that's less convenient about it, you get extended hours for its trades, whatever. Actually, SPY may also. I mean, but. I don't know. SPX is kind of the default contract. The other thing is, and this really only applies to the institutional side of the business. I don't really do this anymore the way we're trading right now. You might wonder sometimes, you're looking at SPX and you see these big boxes trade. What's a box? That's when somebody trades two deep synthetics, or as they are known in that world, combos. What is that? Buying a call, selling a put of the same strike and expiration, or selling a call, buying a put of the same strike and expiration. And oftentimes you'll see these things trade and you'll say, why in one expiration is somebody buying a deep call, selling a far out of the money put, and then buying a deep put and selling an out of the money call of all of the same expiration? So you'll see this go on like a $500 box. So with SPX at 5,000, you see the 47.50, 52.50 box trade for good size. What is going on And what is happening is that when we were dealers, this was basically a way, it's essentially interbank lending. So you can think about that instrument, because it settles to cash, as basically like a zero coupon bond that matures on the target date. That $500 box is going to trade to $500. That's what it's going to settle to on the expiration date. So if I buy that box, you know, and I pay, let's call it $485 for it, right? So I'm paying $485 for something I know that's going to be worth $500. So that means I'm going to make $15 on the $485 over that course of time, or 3%. So it's, if I don't have a lot of premium on my books, because the OCC margins all the dealers, you actually have to put the premium up. If I'm short premium on balance, you know, I can buy that, basically carry no net premium, and some dealer who's long a lot of premium and actually has to post is basically going to borrow from me at the risk-free rate. So you will notice, if you calculate those boxes, they're going to track pretty close to things like euro-dollar futures and SOFR and all that kind of stuff. It's an interbank lending thing. So it's another reason why we traded it. The other thing is that when you're trading on the institutional side, SPY trades much tighter bid to ask. So when you're trading electronically, it's literally, you can just let it fly. You're not going to get a bad price trading SPY options. I say that and watch something weird happen. So watch prices all the time. But look, as a rule, it's not going to happen. SPX, we had phone brokers. So worked everything in the middle. In real life, SPX trades as tight or tighter than SPY does in vol space. But if you're trading electronically, SPY is fine. Doesn't make any difference. So cash settled, European, just makes things a whole lot easier. God, how do I chew up an hour so quickly? I don't know. An hour is an hour. It should only take an hour. Somehow, for me, it always feels like 15 minutes. For those of you who hung around for this whole hour, once again, thank you very much for watching. Really appreciate your time and attention. Really appreciate your questions. You guys sent in some great ones. And I really look forward to doing this again, which we will on Monday at 4:15. Like, subscribe, and keep the comments coming. As you see, I try to answer them when I can. Thank you.